Hello everyone, welcome to week 6 learning videos once again. And this is learning objective 2. In this learning objective, we discuss the concept of momentum, which is shown to be a very effective investment strategy, and we look at different ways that momentum strategy can be executed by differentiating between time series momentum and cross-sectional momentum. Momentum is an investment strategy where you make the decision to either buy or sell stocks based on an evaluation of the historic returns of these stocks. There is luminous evidence that financial asset prices display momentum, despite the fact that at face value, this investment strategy appears to be quite parsimonious. There are multiple ways momentum can be executed, and the relative benefits and returns generated by momentum strategy can be largely depend on the specific strategy that is employed. So the two key types of momentum strategies are time series momentum and cross-sectional momentum. Time series momentum is the investment strategy whereby you look at the security's own past time series of returns and use that to predict future returns. Quite simply, this is the investment strategy based on the idea that stocks that have had positive abnormal returns over a past intermediate period of time will subsequently continue to have positive returns due to the momentum that is in place. Similarly, according to time series momentum, stocks that have had negative abnormal returns over historic intermediate periods will continue to observe negative abnormal returns into the future. Cross-sectional momentum, on the other hand, is not simply based on its own past returns of individual stocks, but it is the concept that is based on ranking stocks according to their returns. So with cross-sectional momentum, what we do is we look at the returns of all securities within particular feasible set over a time horizon. And it's important to note that with momentum, we look at an intermediate time horizon, for example, last 3 to 12 months. So based on performance across that intermediate period, you then rank all stocks from best performing to worst performing. And the idea of cross-sectional momentum strategy is that you take a long position in those stocks that relatively perform better over the evaluation period, and you take a short position in those stocks that perform relatively worse. So time series and cross-sectional momentum are clearly two different strategies, given that cross-sectional momentum looks at relative performance, whereas time series momentum only focuses on actual performance of asset across time. Let's look at what the academic evidence shows us regarding the momentum investment strategy. There is actually a vast academic literature that documents the success of momentum strategies both in the US and globally, including Australia. In fact, the evidence tends to suggest that before taking into account of transaction costs, the trading costs, a momentum strategy can generate abnormal returns of approximately 1% per month. Now, obviously, when we incorporate market frictions, like transaction costs, the return will be significantly reduced. However, it still appears that it is a strategy that would survive after costs. Another way to consider the benefits and relative merits of momentum strategy is listen to words of, we see on the screen here, Gene Fama. Many of you will have heard of Fama because he is considered to be the father of the efficient market hypothesis. Efficient market hypothesis, if you remember, states that security returns cannot be predicted by either past returns or publicly available information. So if there is anyone who should be arguing that momentum strategy doesn't work, one would believe that Fama would be that person. Consistent with that, back in 1970s, when the efficient market hypothesis was first developed, Fama was quoted as saying the future prices cannot be predicted by analyzing prices from the past. So very definitive statement, which basically suggests momentum should not work. However, let's fast forward 40 years and let's look at a paper that Fama wrote with his co-author Ken French in 28 and where he states that momentum appears to be the strongest and the most basic anomaly. So Gene Fama, the father of market efficiency, is saying that there appears to be strong evidence of momentum in stock returns and argues that it does not appear to be explained by rational models of risk. So as we spoke before, there are these two different momentum strategies where a time series momentum strategy only focuses on the past performance of security returns themselves. So basically it's going to buy any stocks that have outperformed the market and sell any stocks that underperform the market. One potential issue with a time series momentum strategy is that it can be quite susceptible to variation in the aggregate market return across time, because you could have periods where you have a whole lot of stocks that are performing really, really well, so you long a large number of stocks. Or you can have a period where you short in a whole lot of stocks because they were performing poorly compared to the market. Cross-sectional momentum is more balanced compared to time series momentum. By construction, in cross-sectional momentum, you will be taking a long and short position in the same number of stocks because of the process of ranking and investing based on relative performance. So let's have a quick think about how a cross-sectional momentum strategy works. So when we do with a cross-sectional momentum strategy, let's imagine that we are here starting at day T. At day T, what we do is we look back at intermediate past period returns. Now, this is an important point with respect to momentum. It is an intermediate return strategy. So we look back over a period last 3 to 12 months, and we will look at down the track. We will actually get different results if we look at momentum over a longer time period, say 5 years, rather than 3 to 12 months. For now, we are focusing on the period 3 to 12 months. Different investors will choose different look back windows depending on what they think is the most valid. But let's assume for the sake of this exercise, we look back a year or looking back return of last 12 months, and we are ranking stocks based on those returns into deciles. So we have got, based on the moment over the last year, the top 10% of the stocks, the next 10% of the stock through to the worst 10% of the stocks. We are going to take a long position, or we are going to buy the top performing decile, and we are going to take a short position or going to sell the worst performing decile. We then hold the portfolio for a subsequent intermediate period again, let's say 12 months, and at the end of 12 months we will rebalance. So what does it mean? At the end of the 12 months, effectively, we will be back at time T again. So we will do the same thing again. We will reform our portfolios, re-rank again based on last year, and continue buying and selling. So we are trading to bring our portfolios to ensure our long position is always full of winners and the short position is always full of losers. But it is important to note that while there is some turnover associated with this portfolio, turnover is relatively limited as it's on the rebalancing on the portfolio. So as we speak before, there is a huge amount of evidence that validates the success of momentum strategies across a whole range of markets, and it's also important to note that not only is momentum shown to exist in equities, but it's been shown to work in other markets as well. So Jagadish and Titman, Griffin G. Martin, these are some prominent examples. Marquich, Oye, and Peterson demonstrate that momentum works in equities, bonds, currencies, and commodities. So let's see some practical example with respect to returns on a momentum strategy. So what I have done here, I have documented here the performance of a momentum strategy across the period of 1927 to 2011 in the US equity market. So basically what I have done is, at the start of each year, I have looked back at the previous 12 months and I have created those decile portfolios we spoke before, whereby we got the decile of best performing stocks over the last year and the decile of worst performing stocks over the last year. I hold the portfolio for 12 months And at the end of the year, the portfolio is rebalanced. That is, I reconstruct the winner and loser portfolios based on the last year performance and so forth. As I look at the returns through time of this portfolio that I am rebalancing every year, what we find is there are the average monthly returns of stocks where you can see the losers and winners are actually performing quite differently. So as we can see clear evidence of return continuation, that is those stocks that performed worse last year on an average actually tended to be the worst next year, and they only generated a return about 0.3% per month. And we can see that there is a monotonous increase in return as we move across deciles, and we see that those stocks that performed best last year, they generate a return of about 1.5% per month over the subsequent years. So we can say that there is a huge return differential between past winners and past losers. So this investment strategy where we buy past winners and sell past losers is quite profitable. So this is the example of United States. What about Australia? Well, in Australia, we see the same results. I have done exactly the same thing for Australia for the period 1976 to 2012. Ranked stocks based on their returns over the last year, held them and rebalance annually. So we can say once again that there is a significant difference between the return generated by the loser portfolio and the return generated by the winner portfolios. Now, one obvious question you might ask that, well, is this return differential just explained by risk? Is this result is simply due to the fact that past winners may be more risky or more volatile? So then look at the bottom here. What I have done here is I have reported the Sharpe ratios. And as you can remember, Sharpe ratio is the risk-adjusted return. So I have shown the Sharpe ratios for the loser and winner portfolios. And if you can carefully see that the Sharpe ratio of the winner portfolio is significantly higher than the Sharpe ratio of the loser portfolio. So you can see that the return differential between the winner and loser portfolio persists even after controlling for risk. So another way to look at the momentum return is to look at the zero investment return. So what we do is here is let's create what we call a zero investment portfolio. So zero investment portfolio means where we long a portfolio of winners and short a portfolio of losers. Then we are looking at the cumulative return differential between the portfolio of winners and portfolio of losers over time. We can see the time period is between 1976 to 2012, and there is a fairly consistent upward trend which indicates us that across time, past winners fairly constantly outperform past losers. We do have some large drawdowns, particularly in this period and in this period. That's going to be important, and we are going to discuss it shortly. But still, we can see that it's a persistent anomaly that seems to outperform across the market over the time periods. So it's important to note that this is a strategy that has been adopted across the funds management industry. So just as an example here, you can go to AQR Capital Management website, which documents momentum indices that they use, and they use momentum as an important factor across many of their investment strategies. So now we know about momentum theoretically. Now there is a range of different ways that we can try to implement a momentum strategy. We have discussed so far looking at relative past returns. With respect to that strategy, remember we look back over the last intermediate period, say a year, we rank our stocks. However, there are other strategies that are parsimonious using simple heuristics that can also look at the returns on an equivalent momentum type of strategy. Here we are looking at what we call the 52-week high. This is an investment strategy which was introduced by George and Huang in 2004. The idea here is that they look at a current stock price relative to its 52-week high, 52-week high being the maximum price that the stock achieved over the last year. Basically, they say that a price close to its 52-week high must be a stock with positive moment that implies that its current price is its recent maximum, whereas a stock whose current price is long away from its 52-week high must be a loser because it's moved quite a long away from its peak share price. So based on this idea of momentum, they buy stocks closer to their 52-week high and they sell stock that are long away from their 52-week high. The key benefit here being is that the 52-week high price is really easily accessible. So this is really simple investment strategy to implement. So this is the returns of 52-week high momentum investing. The results are similar to the evidence we saw before. So what this Huang did, I mean George and Huang did, they find that portfolios of winners which are those close to 52-week high, when they buy them and hold them to 6 months and rebalancing portfolios in every 6 months, those portfolios tend to outperform past losers by about a 0.5% per month. This is statistically significant if you look at the T statistic, and you can see that these return generates tend to be quite similar to returns on individual cross-sectional momentum that we looked before, and also the momentum industry portfolios. So this is 52-week high. This is individual momentum portfolios that we discussed earlier, and also the momentum from industry portfolios. So now we saw this evidence earlier in terms of US data, but there is a large number of academic studies that confirm the existence of momentum in Australia as well. So a huge range of studies here, which is saying that yes, momentum does appear to be an effective investment strategy in these countries. If you can manage some time, you can have a look at these papers to get an idea about the nature of momentum returns in Australian market. So if you just want more evidence with respect to how successful momentum is across time, so this is a table looking at momentum across the globe. So it's an international momentum from a paper by Griffin, G. and Martin in 2005. In this paper, they look at relative performance of investing $1 in one of three investment strategies. Those three investment strategies are investing $1 in a portfolio of past winners, investing $1 in a portfolio of past losers, and investing $1 in the market return across time. So if you look at these three lines, these black dotted lines, that shows the return from investing in a momentum portfolio. This black thick line shows the return generated from investing in a market portfolio, and this light black line shows the return generated by a loser portfolio. And you can see that there is a huge difference between these two. I mean the return or the cumulative wealth generated by momentum portfolio and the wealth generated by a market portfolio. You can see that $1 gives a cumulative wealth of $266 from a period of 1975 to 2000 as it was invested in a momentum portfolio, whereas $1 ended up $57.36 when it was invested in a market portfolio. However, $1 ended up only $32.42 when it was invested in a loser portfolio. So you can see that momentum is not a phenomena that is observed only in a particular time period. It is observed across time. I have spoken so far about the fact that momentum is an investment strategy that focuses on an intermediate time frame, that is looking at past returns over the period of 3 to 12 months, then holding your portfolio over the subsequent 3 to 12 months and rebalancing. So one obvious question can arise: what happens if we look at longer? I mean, if we hold the stocks, say instead of 3 years, 4 years, 5 years, instead of just holding the stock for 12 months. Well, there is actually quite a lot of evidence that shows that over longer time periods, momentum is reversed. We actually see this evidence in contrarian strategies. Over periods greater than 12 months, if you hold that portfolio, let's say for 5 years, you would actually generate negative returns. That is saying that you if you wanted to rebalance every 5 years, you should actually bypass the losers rather than pass winners that the momentum strategy is with. Now, this reversal, a momentum reversal across a long period, this mean reversion, as we might call it, it's actually a really important result. It's important because it contributes evidence to the root cause of what is attributing to momentum profit. The reversal of momentum profit across times tells us that momentum is caused by some types of overreaction. If the market is overreacting to something, you find the price moving away from its fundamental value. Eventually, the price has to come back down to its fundamental value, which is what we see. So as an example, we have got the momentum returns. We have created our portfolio and hold it up to 60 months. So as we discussed so far, that if we hold the portfolio up to 12 months and it generates a positive abnormal return, you can see that up to 12 months we have positive abnormal returns. However, as we hold the portfolio longer than 12 months, let's say up to 60 months, you can see that after 12 months, starting from 13 months and onwards, the returns are mostly negative. Okay, so you can see that momentum is an intermediate type strategy. So you need to hold it up to 12 months, and if you hold it longer, you will actually earn a negative return, or you actually underperform the market. Now, momentum is not confined to equity asset class only. As I indicated earlier, momentum is evident across over a large range of different asset classes. This is a paper by Marquich, Oye, and Pedersen in 2012, where they look at commodity returns, uh, currency return, and international stock indices, and also fixed income securities, and they find that momentum is clearly evident in the commodity, these blue lines, and also in currencies and international stock prices, and last of all, fixed income securities. So across all these instances, we can see that these bars are positive. That is, the returns on momentum investment strategies are constantly positive. So it appears to be pervasive. It appears to exist across time periods, across markets, across asset classes. So this is really strong evidence of what appears to be a simple investment strategy. It gives us great strength in the notion that maybe this is something that investors should consider as a potential strategy that they can use if they hold a philosophy that markets are less than perfectly efficient.